Welcome to my video on inventory flows. This video will introduce the three basic assumptions of FIFO, LIFO, and the weighted average cost methods, as well as specific identification. Before we get into our flows, I want to address the nature of merchandise. When dealing with physical inventory, it's important to ensure that some of it doesn't walk out the door on its own. You don't want your employees exercising the old five-finger discount. So how do we stop such asset misappropriation from happening? To do so, we need to understand why fraud like theft occurs. We can do that using something called the fraud triangle. The three sides of the fraud triangle represent specific conditions that, when all three are present, guarantee that fraud will occur. The first side is internal pressure. This occurs when an employee is feeling some discomfort from a lack of money. Maybe he or she has an abundance of debt. He or she might be indulging in an expensive or an addictive vice. Or the person could just be living beyond his or her means. Whatever the case, something is forcing the worker to experience an intense desire for additional funds. The second side is rationalization. Everyone has an internal moral code, and few people would argue that stealing isn't wrong. But a person might develop some mental gymnastics to explain why his taking the company's property isn't actually stealing, or why doing so vindicates an even greater perceived injustice. At that point, the only thing stopping that person from committing theft is fear of consequence. Finally, we have opportunity. Imagine that employee finagles himself into a position where he has access to the inventory as well as the accounting records. He could take some inventory home to sell on eBay, alter the records, and very likely not get caught. At that point, fraud is 100% guaranteed. However, all a company needs to do is stop one of these sides from developing. Businesses can try to hire only employees with iron moral compasses and hope those employees also have wise money management abilities. But preventing opportunity to steal is one of the circumstances over which the company has the most direct control. Take away that side, and the other two are non-factors. We have two primary objectives in controlling inventory. First, we want to protect it from damage or theft. We need a system of accountability that prevents customers or employees from stealing the inventory. Accidents may happen, but we also need policies and procedures to prevent inventory from being damaged while in our possession. To a certain degree, these events are inevitable, but we can seek to minimize their occurrences as much as possible. Somewhat related to the first point, we want to accurately report the value of our inventory on the financial statements. The balance in our inventory account should reflect how much inventory we own. We don't want to report that we have more assets than we actually do. Conversely, we also don't want to overlook reporting inventory that we do own. A thorough documentation system is an effective means of safeguarding a business's goods. Common documents used include purchase requisitions, purchase orders, invoices, and receiving reports. Purchase requisitions are a formal request to purchase a specific item. Purchase orders authorize the purchase of a specific inventory item from an approved vendor. Once that purchase is made, the seller company sends an invoice which verifies what was purchased, when the purchase was made, how many units were bought, and the final purchase price, among a number of other details. Finally, a receiving report will be included with the actual shipment detailing its contents. These documents provide a reconciliation process to verify what the company bought. Obviously, such a system ensures that the amounts we entered into the system are accurate. Having accurate information helps deter employee theft. Unscrupulous employees may think twice about pilfering inventory if discrepancies will be noticed and eventually investigated. Practically, the process may look similar to the following. If a department needs to purchase something, they'll notify the purchasing department. For instance, if the sales department needs some more inventory, it'll fill out a purchase requisition for that inventory and send it to the purchasing department. The purchasing department will use that requisition to create a purchase order. The purchase order serves as the actual request to purchase said item or items from a seller. A copy of that purchase order will be sent to the selling company to initiate the purchase. The purchasing department will also make another copy of the PO and send it to accounting. Upon receiving and processing the purchase order, the selling company will generate a sales invoice, which will be sent back to the buying company's purchasing department. The invoice serves as confirmation for what was ordered. Of course, the sales department will keep a copy of the invoice for its own records. The purchasing department will then make a copy of the invoice and send it to the accounting department to be matched with the purchase order. Eventually, the item will be shipped to the buying company's receiving department. With the delivery, the item will include a receiving report that details what items are contained within the shipment. Receiving will then make a copy of the receiving report and send it to accounting. Accounting now has at least 3 documents to reconcile what the company ordered, match it with what was purchased, and match that with what was received. This reconciliation helps ensure the amount entered into the journal entry will be accurate. How we report purchases and sales of inventory will be heavily influenced by 2 main factors. The first will be which type of system we use to track inventory. The systems can be either perpetual or periodic. Under a perpetual system, we record a journal entry every time we make a purchase or a sale. If you watched my videos on merchandise purchases or sales, you've already seen this in action. Whenever we make a purchase, we debit merchandise inventory and credit either cash or accounts payable. Whenever we made a sale, we would debit either cash or accounts receivable, credit sales, and we debit cost of goods sold, then credit merchandise inventory. These journal entries get recorded and posted to the ledgers every time a transaction is made. Consequently, the ledgers are perpetually updated to the current balance. With the periodic method, the accounting records are updated at the end of the month, not after every transaction. The periodic method is continually becoming more and more irrelevant. Decades ago, it was used for businesses that sold very large quantities of goods. When those businesses were moving large volumes of merchandise continually throughout each day, journalizing transactions at every sale or purchase wasn't practical. With the universal prevalence of UPC codes, that inconvenience no longer applies. If you've worked in inventory, you know the process. When a delivery of merchandise inventory arrives, a worker scans it into the inventory records. When a customer takes one of those items to the checkout and the cashier scans that UPC code, the register automatically records the sale of that item. For this reason, I'll devote most of my time to the perpetual method. As far as the periodic method is concerned, while I won't cover the journal entries, I'll at least cover how cost of goods sold and the ending merchandise inventory balances are calculated. Understanding that process will facilitate understanding the perpetual system. The next factor is the cost flow assumption. With specific identification, we know which particular inventory item was sold, and therefore the specific cost to record in the journal entry. For this reason, specific identification is not technically a flow assumption. We're not assuming which inventory item was sold. Rather, we know for certain the inventory item that was sold. Specific identification is commonly utilized in businesses where each inventory item is very unique. Auto dealerships are an ideal example because each car on the lot is likely different from the others in terms of make and model. Even two or more cars with the same make and model can be different in terms of year, base or premium model, additional features, and so forth. Jewelers are another good example. Each article of jewelry in the shop can be unique in terms of the quality of its precious metals and/or gemstones. When a customer buys a particular ring or necklace, the jeweler tracks which specific item was sold. FIFO and LIFO stand for first in, first out, and last in, first out. These flow assumptions are just what they sound like. FIFO assumes that the first inventory purchased will be the first sold, and LIFO assumes that the last inventory purchased will be the first sold. Weighted average cost is also self-explanatory. With this method, we calculate an average cost per unit and assume that each unit sold cost the business that amount. The milk section of a grocery store is a good example of the FIFO assumption. When a shipment of milk is delivered, the stockers take the cartons to the refrigerator and load them to the shelf from the back. When another shipment is received, they load that through the back as well. The stockers do the same thing should a third shipment come in. When a customer takes a jug of milk off the front shelf, the next most recent container slides to the front for the next customer. That's FIFO. The first inventory bought is deemed to be the first inventory sold. Remember though that this is an assumption, so the presumed flow may or may not match the actual flow of goods. What do some customers do when they pick up a jug of milk? They reach in the back looking for the one with the longest expiration date. We called those customers milkmaids when I worked for Winn-Dixie way back when. If you do that, know that you're messing up the inventory system. Stop it. For LIFO, think of the gardening section of a home improvement store like Lowe's. The bags of soil will be placed on pallets out on the floor. When another shipment comes in, an employee will place that bag on top of the first. When another shipment comes in, he'll place that bag on top of the second. And so the process repeats. When a customer wants to pick up a bag of soil, which one will he or she take? The one right off the top. That's LIFO. The last inventory acquired is the first deemed to be sold. Imagine that 3 identical units of merchandise inventory are purchased throughout the month as follows. If the company sells 1 unit, its net income and merchandise inventory asset will vary depending on which particular item is deemed sold. Let's also presume this inventory has an individual sales price of $20. Let's also presume that we sold 1 unit throughout the month. If we're using the FIFO assumption, the impact on the income statement will be as follows. The 1 unit we sold will yield a total sales revenue of $20. For cost of goods sold, the first unit we bought on the 10th is the one we deemed to be sold. So that's our cost of goods sold. Gross profit will then be $4. When we get to the balance sheet, merchandise inventory will be $30, the 2 units from the 18th and the 24th. If we were to use the LIFO assumption, the income statement would be identical until calculating cost of goods sold. Here, the most recent item from the 24th is deemed sold, so CGS is $16 and gross profit will be $4. On the balance sheet, merchandise inventory will consist of the 2 earliest purchased items from the 10th and the 18th. Under weighted average cost, we'll calculate an average cost of all the merchandise we bought. This process is a simple one. Sum up the total value of the inventory purchased and divide by the total number of units purchased. Our end result of $13.33 per unit will be what we assign to any unit sold, as well as however many units we still have on hand. When we compile our income statement, the 1 unit we sold will be allocated to CGS, yielding a gross profit of $7.67. On the balance sheet, our merchandise inventory will be $26.67, the $13.33 times 2. Note that under a period of inflation, FIFO will give the highest income. This is because the earliest purchased item of inventory with the lowest cost is being deducted from revenues. FIFO will also give the highest value of merchandise inventory on the balance sheet because the most recently purchased merchandise inventory has the higher cost and is presumed to still be owned. In contrast, LIFO will give the lowest income because the most recently purchased inventory, which has the highest cost, is being deducted from revenues. LIFO will also give the lowest inventory valuation since the older merchandise inventory with the lower cost are still deemed to be in the company's possession. Of course, weighted average cost will smooth out any erratic cost changes. If you ever need help deciphering whether FIFO or LIFO is going to yield a higher or lower cost of goods sold, profit, or merchandise inventory balance, think of it in terms of a line graph. This graph shows inventory prices over a period of inflation, prices rising over time. Under FIFO, the first inventory purchased with the lowest cost is what we sold, or what we presume to have sold. It's these lower costs that we assign to cost of goods sold. The more recently acquired merchandise inventory with the higher cost is still presumed to be owned. So that will provide a higher merchandise inventory balance. With LIFO, the effect is the exact opposite. The last inventory purchased is what we deem to have sold. so CGS gets the higher costs. The first inventory purchase is considered to still be owned, so merchandise inventory gets these lower costs. If prices are deflating, the same analysis will show the impact on profit and asset valuations. With FIFO, the earliest inventory is deemed sold, which has the highest valuation. So cost of goods sold will have a higher number on the income statement, yielding a lower number on gross profit. The most recent inventory purchase is what we deem to still be in our possession. This inventory with the lower valuation will provide a lower number on the balance sheet under merchandise inventory. Of course, under the LIFO method, the impact is the exact opposite. Under LIFO, the most recent inventory acquired is what we deem to be sold. This inventory has the lower valuation, so cost of goods sold will have the lower number, providing a higher number for gross profit. The earliest inventory purchase is what we deem to still be in our possession. So this inventory with the higher valuation is going to provide a higher number under merchandise inventory on the balance sheet. Before we go any further, we need to go over some algebra. The formula you see before you, beginning inventory plus purchases equals cost of goods sold plus ending inventory, will be pertinent for the rest of your accounting education and possibly your profession. We can rearrange this equation to calculate cost of goods sold. If we subtract ending inventory off each side of the equation, the ending inventory variables on the right side of the equation will net to zero and consequently cancel each other out. The resulting formula becomes beginning inventory plus purchases minus ending inventory equals cost of goods sold. We can also solve for ending inventory. If we subtract cost of goods sold off each side, the two variables on the right will net to zero, then negate one another. The resulting formula becomes beginning inventory plus purchases minus cost of goods sold equals ending inventory. Most of the time for these videos, we'll be using the previous formula. But please be aware of all three variations. If it helps to comprehend the previous formulas, think of them as follows. We start with our beginning inventory. We purchase some more inventory, so we add that to our beginning inventory. You may see this sum referred to as cost of goods available for sale. This number is the maximum amount of inventory that a company could sell during a period. If the business completely sold all of its merchandise inventory, every bit of it, this is how much would move out the door. Back to our formula. We subtract out of this sum our cost of goods sold. Cost of goods sold represents how much did we actually sell during the period. With these items gone, the merchandise inventory that remains is our ending inventory. Applying this information to the accounting cycle, we start with our beginning inventory and add to it our purchases. This sum yields our cost of goods available for sale, from which we can take out our cost of goods sold, and we're left with our ending inventory. cost of goods sold will go to the income statement as an expense to reduce our revenue, and ending inventory will go to our balance sheet in the current asset section. In the next reporting period, the ending inventory from the previous period becomes the beginning inventory for the current one. Then this process repeats itself. Add purchases to arrive at cost of goods available for sale, break out cost of goods sold and ending inventory to be reported on the income statement and balance sheet respectively, rinse and repeat for the next period, and so forth. Let's close this video by covering specific identification. You'll find it very intuitive, and it'll be a good review of the journal entries. Observe the following inventory transactions. We have beginning inventory on September 1st, which consists of 40 units at an original cost of $670 per unit. This yields a total inventory valuation of $26,800. We then have a purchase on September 4th and 2 sales on September 7th and September 15th. Note that for the purchases and beginning inventory amounts, the per unit amount is the item's cost. For rows that are sales, the per unit amount is the item's sales price. Back to our September 4th transaction. We purchase 120 units at $690 a piece. So what's our journal entry? Debit merchandise inventory and credit either accounts payable or cash. The amount, $82,800. On September 7th, we have a sale of 60 units. Imagine that our records indicate that this sale consists of 20 units from beginning inventory and 40 units from the September 4th purchase. How do we record this transaction? Remember that when we sell merchandise inventory, we need to record 2 entries. The first of which, we recognize the revenue earned from this sale. So we'll debit either accounts receivable or cash and credit revenue. Next, we need to remove merchandise inventory from the books. So we debit cost of goods sold and credit merchandise inventory. Now we need our amounts. Starting with the revenue earned, we use the units sold times the sales price per unit, or $67,200. Finally, we have the more challenging part. What's the cost of merchandise inventory sold? We sold 20 units from beginning inventory, which cost $670 per unit, and 40 units from the September 4th purchase with a cost of $690 per unit. Do the math, and that amount works out to $13,400 plus $27,600, or $41,000. We have yet another sale on September 15th, which consists of 10 units from beginning inventory and 40 units from our September 4th purchase for a total of 50 units sold. We record the exact same debits and credits from the September 7th sale. Debit AR or cash and credit sales, and debit cost of goods sold and credit merchandise inventory. Our revenue earned is 50 units times the sales price of $1,120 per unit, or $56,000. How do we calculate our amount for the second journal entry? 10 of the units sold came from beginning inventory at a cost of $670 per unit, and 40 came from the September 8th purchase at $690 per unit. The two products come out to $6,700 and $27,600, which sum to $34,300. I want to take a moment to re-emphasize that the specific identification method of tracking cost of sales is not a cost flow assumption. We're not assuming anything about which items of merchandise inventory were sold. We know the exact items that were sold along with each one's specific cost. Let's consider some transactions from the latter half of the month. On September 18th, we make a purchase of 100 units at a cost of $700 per unit. Record that purchase as we usually would. Debit merchandise inventory and credit accounts payable or cash for $70,000. On September 21st, we sell 80 units. Imagine those 80 units sold consisted of 10 units from beginning inventory, 20 units from the September 4th purchase, and 50 units from the September 18th purchase. We'll debit accounts receivable or cash and credit sales revenue, then debit CGS and credit merchandise inventory. Our debit and credit amounts for the sales portion of this transaction is the sales price multiplied by the number of units sold. So 80 units times $1,120 per unit, or $89,600. To expense the merchandise sold, we examine which items of inventory were sold and their respective costs. We sold 10 units from beginning inventory, which had a cost of $670 per unit, along with 20 units from the September 4th purchase with a cost of $690 per unit, as well as 50 units from the most recent purchase on September 18th at a cost of $700 per unit. Multiply those out and sum the products, and we get a cost of merchandise inventory sold of $55,500. We book another sale on September 25th for 30 units. Our inventory records indicate that the sale consisted of 10 units from the September 4th purchase and 20 units from the September 18th purchase. It's the exact same entry as on September 21st. Only the debit and credit amounts will change. Our revenue earned will be $33,600. 30 units times $1,120. We calculate our cost of sales in the same manner as before. The sale contains 10 units from September 4th at $690 per unit, and 20 units from September 18th at $700 per unit. That'll work out to be $6,900 plus $14,000, or $20,900. On September 29th, we make one final purchase transaction for October. Simply debit merchandise inventory and credit accounts payable for the number of items purchased times the price per purchase. Hopefully this is very easy, almost intuitive. That said, this process does require a somewhat meticulous attention to detail. How do you know you did it correctly come the end of the month? As it just so happens, that formula of beginning inventory plus purchases equals cost of goods sold minus ending inventory can serve as a sanity check. We know our beginning inventory, $26,800. We also know how much we purchased. Sum the $82,800 plus the $70,000 plus the $84,840, and total purchases will be $237,640. What about cost of goods sold? We have that one too. Just look back at our cost of goods sold debits from our journal entries and sum them. $151,700. Lastly, we have ending inventory. We can determine this by examining how much we have left from beginning inventory and each purchase. To put it another way, we're going to deduct our units sold from each transaction to determine how many units we have left at each cost. For instance, on our September 7th sale, we sold 60 units. 20 of those units came out of beginning inventory, and 40 came out of the September 4th purchase. On September 15th, we sold 50 units, of which 10 came out of beginning inventory, and 40 came out of the September 4th purchase. On September 21st, we sold 80 units, 10 from beginning inventory, 20 from September 4th, and 50 from September 18th. Finally, on September 25th, we sold 30 units, 10 from September 4th, and 20 from September 18th. Of our beginning inventory, we sold all 40 units, so we have none left. From our September 4th purchase, we sold a total of 110 units. Considering we bought 120 units, this means we have 10 left. From the September 18th purchase, we sold a total of 70 units. If we bought 100 units, that means we have 30 left. Of the 120 units we purchased on September 29th, we didn't sell any. So all 120 units are present. To get the total cost of ending inventory, we take our number of inventory units from each grouping and multiply them by their respective costs. This computation will yield 0 plus 6,900 plus 21,000 plus $84,840, which total to $112,740. Now we can verify that our beginning inventory combined with our purchases matches our cost of goods sold combined with ending inventory. In this case, $264,440 reconciles to $264,440. This check doesn't absolutely guarantee that your numbers are correct, but it does provide a solid level of confidence that it probably is. That concludes this introduction to cost flows. The next video will cover FIFO and LIFO in more detail. If my videos are helping you and you want to return the favor, you can leave a thumbs up and a comment or a question below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course. Finally, consider sharing my videos with your fellow classmates and possibly your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.